So thank you everyone for joining us on this week's Insignio Speaker Series. I'm happy to be joined today by François Collet, all the way from Paris. François, thank you for joining us.
Hi, Hamid.
So François is joining us from DNCA Alpha Bonds, which is associated with Natixis, the Natixis family of funds. So maybe François, you're sort of running an absolute return strategy, right? Where you're focused on exceeding the euro short-term rate, which is is a reference rate established by the ECB, and currently it's around 3.6% or so, right?
Yes, exactly. We try to beat money market rates plus 200 basis points. We have different share classes. So for the US dollar share class, it would be SOFR plus 200 basis points. That's the target for the fund.
SOFR plus 200. Okay. So that's a good reference for people to have. So it's sort of like it's more of an alternative macro strategy. So maybe let's dive in, because I'm sure that a good portion of what you're doing, even though you're obviously focusing on fixed income, is on the macro side, right? So maybe give us a little snapshot, 30,000 foot view of how do you see things right now. Let's talk about maybe the major blocks. Let's talk about the US, let's talk about Europe, and also potentially China.
Okay. First, maybe I'm going to give you a brief overview about what we think about long-term views, because I think it's really important to have this in mind. Long-term views for us, if I can summarize in one word, would be around stagflation. What we see is three main challenges for our economies long run. First one being climate change, second one being the rise of geopolitical tension, and the third one the aging of the population. Everything is putting downward pressure on the supply side for each of these three challenges, and they are putting upward pressure on the demand one, meaning that as we'll see more geopolitical tension, we'll see more populism, we'll see more military expenditures. When it comes to the energy transition, we will need to finance the energy transition. So everything is pointing toward dampened potential growth and kind of permanent support for the demand side, which is going to lead to long-term inflation staying higher than in the past. And
let me stop you right there 1 second, François, because we actually are in total agreement with you on sort of a long-term view here on the inflationary side. Perhaps we might disagree a little bit on the growth. I haven't heard your views on growth, but it would be very interesting to hear what are sort of the reasons you think, which we do as well, that we're in a structurally higher inflation environment than we have seen over the past 20, 30 years or so.
Yes, well, I think that's quite obvious that we're going to face some commodity resources scarcities, whether it is in terms of commodities or in terms of labor force, due to the fact that we have an aging population. So it's more and more difficult to find labor workers. We've seen years of we can say inflows in the global labor force due to the entrance of China in the global economy, but now labor force in China is starting to shrink.
That's going to reverse, yeah.
Exactly, and that's a long-term headwind for or a long-term tailwind for inflation. So, and one other thing which is really important, I know that central banks will always stay vocal against that, but we have a kind of fiscal dominance by central banks. That's a fact. We have too much public debt, and the only acceptable way to decrease this very high leverage of public debt is to let inflation running slightly higher than the targets. Yes, 8% inflation, 10% inflation is a credibility issue for central banks, but letting inflation running around 3-4% would be okay for them, and it would.
I couldn't agree with you more on that statement. By the way, I could not agree with you more. Yeah.
So that's the long-term picture that we have in mind. Yes, low growth, high inflation. High inflation rhymes with volatile inflation. That's very important. Each time you've seen a cycle of high inflation, it's a cycle of very volatile inflation. So that means that maybe next year at one point we'll see inflation below 2%. That's clearly a possibility, maybe nearing zero at one point because of some base effect or so on. But I think that this disinflation will be temporary, and that's very important. And in fact, if central banks want to theoretically maintain inflation around 2%, it's not because 2% is a magic number. It's because it's a low enough number to keep inflation stable and not very volatile. And the issue is not the level of inflation, but the volatility of inflation. And
Right.
very difficult to keep it at 4 or 5% with low level of volatility. And that means that we'll see higher volatility in fixed income market and higher volatility in financial markets going ahead.
Let me ask you something, and I want to touch upon growth here 1 second, but just something. Do you feel that we're in a structural bear market in sovereigns right now?
No. Not a structural one, because I think that real rates are already at a quite decent level, maybe higher than what is telling you central banks about their long-term views on real rates. And when it comes to inflation expectations, we are roughly around, it depends if you look at swaps or govies, but it's around, let's say, 240 to 50%, 2.5%. I don't think that we can go much further than this level, because if you have, let's say, 4% of inflation expectations, 4% of inflation break-evens, that would be a threat for central bank credibility. So I think that globally speaking, most of the damage has been done last year in fixed income. It's going to be difficult to perform very strongly this year. I still think that money market is going to beat fixed income this year. Long-term bonds, but nevertheless, we're going to post or to see positive return for long-term govies. So no structural bearish bias about govies, because I think that we cannot afford to see rates going toward let's say 6% on the US 30 years bonds. That's not possible.
Okay, and so let's discuss a little bit more your view, the other side of that equation, or the second part of that word that you use, stagflation. So you guys have a structural long-term view of low growth. Tell us a little bit about that, and maybe address some pushback that you might get in there, that we're having right now some transformational technologies that could potentially enhance productivity to maybe offset some of the demographic headwinds that we're facing.
Yes, sure. Yes, so this view of dampened potential growth is done by the fact that, yes, by demographic, and by the fact that labor force is starting to shrink, and that's the most important source of support for potential growth. We are seeing a kind of Cold War between US and China, or the East and the West, and this is putting, I think, global trade at risk, and this is not good for global growth, and this is not good for productivity. That's a point. Two setbacks or two pushbacks that I can give that we saw since the beginning of the year about these long-term views. For sure, the first one is IA, which for sure is long-term going to be something positive for growth, and maybe it's going to increase potential growth by some tenth. Some basis points, but it's not a big game changer long term either. It's not going to increase 100 basis points potential growth either. And the second one is the the surge in that we've seen this year, and I think this is a part of the explanation of surprising resilient growth in the US, is the fact that we are seeing quite a very important rebound of immigration. And this means that labor force that we thought were going to increase at a very low pace is raging back because of immigration, which is reversing Trump's years and the COVID years.
Okay, so now that you've sort of presented your long-term macro view, maybe let's then bring it more near term. What's your outlook for? Let's start with the U.S., and if you want, we can discuss some other regions like Europe and China as well.
Yes, sure. Well, in the US, we see deceleration of growth. And it's the case since the beginning of the year for us, or since even I would say 1 year, but we're still not in the recession camp. Recession will maybe come 2024. I think it's too early to be able to forecast what could be a recession next year. Yes, we will see fiscal drag next year. We will see the impact of monetary policy tightening, and we will see the impact of credit contraction. But in front of that, we have one very important support for demand, which is short-term, which is leading short-term growth, is the fact that we are in a very quick or very fast disinflation. It's a disinflation year, and as inflation is cooling very quickly, real wages are going to be back, or are already back, in positive territory. And if you have high real wages, I don't see why the demand would collapse. We are not seeing either some very important imbalances from the private sector, so no need to.
Are you concerned that the rise in real wages could feed back into inflation, in the sense that it could lead to another second wave of inflation here? We've seen recently market-based inflation expectations, 10-year break-evens, five-year forwards kind of tick up a little bit. I mean, they're not at worrisome levels, but they have ticked up. And we especially have noticed some increase in optimism in small businesses in terms of purchases and prices, which tends to lead. Are you concerned that there could potentially be a second wave of inflation potentially in the works, partly because of this rise in real wages, which is, it's working against what the central bank is trying to do, which is to slow down activity?
Yes, I think that's quite an important possibility, and I would give the main outlook for us. Base case is for deceleration of growth, but let's be clear that recession risk and reinflation risk are balanced, and I wouldn't put more probability on a recession risk than on a reinflation or on a second wave of inflation, because, as you said, real wages up are going to feed the demand, and I don't see wages going down. I don't see a lot of layoff because of these demand staying strong, and therefore it's totally a possibility that we see a kind of second round effect on inflation. For that, we would need to see, I think, more synchronized growth, because to be honest, we are lacking some growth traction from Europe, from China, and US is kind of alone. Well, not really alone. We have some good news coming from India, some good news coming from Japan, and some other economies. But at the end of the day, it's very difficult for global economy to run hot without both Europe and China.
Right. So you don't see, and François, maybe just tell you, if you can move a bit closer to the microphone. I've had some comments that it's a bit harder to hear you. Okay. So maybe just move closer to the microphone, or if you can, try to speak up a little bit, please. Do you see, because you're definitely correct, and we're seeing some resiliency in the US economy. We're seeing, disappointing numbers in China. The recovery has stalled quite a bit. And Europe numbers. I'm very curious as to especially get your viewpoint on European growth, since you're a Paris-based manager, so you probably have some unique insights into Europe. Please, I'd like to hear those before we jump into the actual fund.
Yes, well, about European growth, really disappointing. About we are in a manufacturing recession in Europe, and it's a fact for us, and I'm quite I've been quite disappointed because a few months ago we were more positive about European growth than US, and this disappointment from the manufacturing sector is quite important. I think a part of the reason is due to weak demand from China. The other part of the equation is done by the fact that we see more sensitivity of European demand from interest rates than in the US, and that the fact that monetary policy, even if it is lower than in the US, is maybe more restrictive than in the US, and we are already seeing a fiscal drag this year in Europe. So that is the explanation. I think that we can avoid a recession as well because we still have much more excess savings than in the US. That's very important. The tourism season is quite bright here. I can assure you that in Paris, it's full of Americans everywhere, and that's a good news for the service sector in Europe.
So you mentioned that. Do you think, for example, Germany is in a recession? I think it's only a matter of time before that gets kind of official. What do you see the prospects going forward? We've heard some comments out of the Politburo in China. I know that Europe is very much tied to what's happening in China. The two are much more closely aligned, which, by the way, is one of the reasons why we think the Europe-China axis is a much more important geopolitical relationship in the world today, because it's kind of the one that's really up in the air. That we know the US and China are headed towards a Cold War, if not already in there. How do you see... Are you, with the statements that have come out of the Politburo recently, do you see any sort of true emphasis in improving the fiscal response in China or other kind of stimulus out of China? Or do you think that they're content with letting the economy continue to stagnate here?
No, I think that they're definitely going to move. They're trying to do it cautiously, but at one point they will need to put on the accelerator, because so far everything that they've done is not working as they were expecting. So they will need to accelerate their stimulus, and I think that's very difficult to have a precise answer on the timing. But before the end of the quarter, we'll see some positive news.
I've seen data on, for example, if we're talking about excess savings in Europe, they're high. Excess savings in the United States, they're still around $500 billion estimated by the Fed. China it's way above. The problem is that they have a problem of confidence in the economy. Is the consumers and businesses just have very little confidence, and when the animal spirits are that low, you can continue to pump stimulus in, but it seems like it's not going anywhere. So it's going to be very interesting to see how this plays out. Let's do a pivot now to your portfolio. How are you positioned, given this macro view, given this long-term view that you espoused earlier, and given the views that you just shared now about the near-term picture? How are you positioned right now in your portfolio, and where do you see opportunities?
Okay, so just before that, maybe coming back on first thing, absolute return. We told about the target performance. I would emphasize that this is a low risk profile absolute return strategy. We have a max volatility of 5%, so we are competing against fixed income. Last year has been a very good one for us, around 8% of performance for the USD share class. It's been done by being short outright of fixed income, and by being long of inflation break-evens, which were the two most important contributors.
Yep, those are two great trades.
Yes, two great trades. And this year we've been reallocating the risk from break-evens toward real rates. That's I think, the most interesting opportunity that you can find today in developed market fixed income. We have a long-term view, which is positive about EM as well. We see a kind of long-term rating convergence between EM and DM countries. They've been much more orthodox in their policy mix during the past decade, and that's why we have a long exposure in some EM rates and EM currencies. And we're still short of quite an interesting number of countries in terms of outright duration. It's the case for Europe with Germany and France. It's the case for Japan and Canada. These are countries where we see still room from the central bank to hike, where we think that in the US it's already it's a done deal by the Fed. They're not going to hike anymore. So it's the same for New Zealand, for Australia. So all these countries advanced in their monetary policy cycles. We are long real rates. And in countries late in the monetary policy cycle, we are short nominal rates. I see. And it's a kind of low modified duration that we have in the portfolio, between 1 and 1.5 years of duration for the portfolio. AA minus average rating, no credit in the portfolio. We think that credit is much more expensive than EM. And at the end of the day, because of these EM debts that we have, because of this currency risk that we own in the portfolio, we still can get north 6% of yield to maturity in the portfolio, which for the kind of quality of assets that we have is something I think quite interesting. Year to date, the performance is at plus 5% for the USD share class. So we are clearly on track to redeliver the kind of performance that we've done last year, around 8%.
Great. Excellent, Francois. So let me delve with you a few questions that have come in. Saying some performance in 2022, is the focus of the fund to manage to a volatility target of 5% or less, or is it to provide an absolute return that beats cash?
Both. We need to beat cash with a constraint of maximum 5% of volatility. It's not the target, it's the maximum 5% of volatility. Usually speaking, you should expect around 4% of volatility for this portfolio, which could be the volatility that you could get for a 7-year US Treasury, more or less. So we try to compete with that and in terms of risk, and to beat that in terms of performance.
Okay, I have another question here. Is ESG criteria more important than absolute return?
Not at all. We have some ESG criteria. As you'll see that we manage mainly govies. When it comes to credit market, we do it through CDS and indices. So it's quite an easy task for us. We have some filters about issuers, and in terms of filters for govies issuers, yes, some countries are excluded, like Russia, Turkey, or so on. But the list of countries which are excluded is not so long for us. So definitely speaking, performance is the target. Risk is the second target. Or I would say the risk return performance is the main target. ESG is the second level of target. So you would
position this as a cash plus in the cash plus portion of the portfolio, correct?
Yes, exactly.
Right.
Exactly. And if you look at fixed income today, you have 4% US Treasuries, 10-year US Treasuries, you have 5.5% of cash. I think that cash still beats by far long-term Treasuries, whether it is in terms of positive carry, but as well in terms of portfolio construction. We used to invest a lot in US Treasuries because they had a permanent and a kind of steady negative correlation with equities. It's not the case anymore. And if you don't have these diversification benefits from treasuries, what I want to say is that the diversification benefit is not better in US treasuries today than in money markets. So you have higher carry, same diversification effect or expectation of diversification effect. I think everyone should look more at solutions looking at cash or cash plus something, which is what we are trying to offer, cash plus 200 basis points.
Excellent. And last question here. I think we have time for one more here. The biggest upside and downside surprise scenario to your thesis?
For the portfolio or for the macro outlook?
Let's go with both. How about that? We have about 3 minutes, so that'll give you enough time to develop both.
Okay. Upside scenario for the macro, yes, is a kind of reacceleration of growth. We kind of see we start to see some sectors which has been very affected, like housing market, where we may have seen already the most pain. So we can see a kind of reacceleration of US growth. And as the Fed is maybe more confident with 3% CPI, they will let this growth reacceleration going on. The most important downside for growth, there are lots. There are lots, but maybe let's say an intensification of trade war between US and or decoupling between US and China would be for sure a very bad outcome.
But that would certainly help your inflationary thesis, though.
Sure,
right?
Sure.
Yeah.
And for the portfolio, I think what we try to do is to balance a lot the portfolio. So we are long US real rates, but we are long of US dollar as well. So if we see kind of recession in the US, maybe that would be bad for US dollar and for the USD, but that would be a positive for US treasuries. And it's exactly the opposite for Eurozone. We try to balance a lot the portfolio. Nevertheless, maybe seeing an ECB much more restrictive, so ECB going toward 5% of short-term rates would be the worst scenario for us, because we would suffer from our short euro FX exposure.
Excellent. Well, Francois, thank you very much. Unfortunately, we've reached the end of our time, but it was a very interesting conversation. I know it's late for you in Paris. It's probably, is it 10 o'clock?
Yes, 10 o'clock, yes.
Yeah, 10 o'clock. So thank you for joining us. I know it's quite late again, and we hope to have you back here sometime soon. Really appreciate you joining us.
My pleasure. Thank you very much, Hamid.
Thank you. Bye-bye.
Bye.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://advisorinfo.sec.gov/.